I think there's a very good chance we get some very, very, very significant turmoil next year. Would not at all be surprised to see markets down or barely up. But the ride along the way, I think it's highly likely we see a true bear market. If you use 20% as the metric, I think it's quite likely we see a pretty sizable drawdown next year.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for a special end of the year recap with the team at New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Preston. Gentlemen, how are you? We're recording this interview right before Christmas Eve. So let me start just by wishing you both a very Merry Christmas, even though this will be running after Christmas.
Hope you have a great Christmas too, Adam. And here we are on Christmas Eve. And yes, I know your viewers will see this after Christmas, but certainly looking at the market has delivered holiday cheer, hitting a new all-time high here today on the day before Christmas. And this is a shortened holiday day as well. And so hopefully this continues for some time. We'll see, and we'll talk about it today.
Adam, I'll just add my Christmas wishes to you and your family and your viewers. I'm joyed to see that we have a white Christmas here outside my window here in Massachusetts, and just makes for a nice little twist to a special holiday for a lot of people, including my family.
All right, well, that's very nice. We're back in California visiting my wife's family for the holidays. We're having a very wet Christmas here. Probably part of the reason why you can hear from my voice. I am a bit under the weather here. I'll apologize in advance, folks. I'm going to lean hard on John and Mike in this discussion because my head feels like it's filled completely with cotton, except for the 100 gorillas with sledgehammers that are trying to bash their way out of my brain. So yeah, this flu I just tested last night. I've got the influenza A strain, I guess. And I'll just tell you, folks, it's not as fun as it looks. So if you can avoid it, I would recommend you do so. But anyways, on to more fun topics. So Mike, as you said, looks like Santa has arrived on Wall Street. We're getting a Santa Claus rally. The S&P is at a record, I think, pretty much as we speak here. As are the precious metals, which we'll talk about in just a moment as well. It's been another hell of a year for the markets. We've had 20+% returns in 23 and 24. Pretty improbable to have another really big up year for the third year in 2025, but that seems to be what the market has now delivered. Looks like it's going to be close to like a 18% return or so for the year. I guess, why don't you tell me about what indicators you guys are looking at? Is this kind of giving you guys the green light going into 2026?
I wouldn't say to get too excited here. I mean, our suite of indicators are solidly bullish. They're in the green zone, and we're starting to see some broadening out. But I'm going to share some charts here so we can take a look at a number of the different indicators, or at least a number of the different charts. So that should be up now. This is the S&P 500. And as I mentioned, we hit a new all-time high. So there's the new all-time high as of right now, 6,937. But actually, before the last couple of days, you could go back to late October. We essentially went nowhere for about 2 months. And here, just the last couple of days, we eked out a new all-time high. Not that much to get excited about, other than it is an all-time high. And don't forget, there's still a few days left in the year. So even though we're up 18% or so, as you stated, who knows where we're going to be at the close on December 31st. And another thing we've noticed is that we started to see a broadening in the market. So if I change the symbol here and we start to look at the equal weighted S&P 500, we can see that we had about 2 weeks ago, we hit a new all-time high. So here's a broadening. Now it's done some backing and filling here the last week, not at a new all-time high today. How about the Russell 2000? The Russell 2000, same thing. We're broadening out. These are good signs for a broader rally, and it immediately backed and filled. The NASDAQ is not at a new all-time high today, still struggling about, maybe a percent or two below an all-time high. So what is this really saying? We've got to take a look at what the indices are actually doing and combine that with our bullish indicators, which, you have to be careful. You don't ever know what the immediate future is going to bring. But now that we're back above the 50-day moving average, we've successfully tested that 50, and 50 is the red one, and the light blue is the 21-day moving average, and we're at an all-time high. There's a much higher probability that we're going to get a squeeze to new highs. And so if I went to weekly, you can see that we went nowhere for 2 months, as I just said, and now we're coming out of that base that could be a launch pad well up into the 7,000s. So everything really you need to think about the risk control, but if we had to guess, I think we're going to get a squeeze higher here in the next few months. And so we're not trading aggressively from that perspective. I'll stop sharing. We are nudging up our equity exposure just a little bit. We were at 45% equities. We just increased it to 47.5, increased it by 2.5. We have very few covered calls or hedges at this point. If we get more extended, if we start to go vertical, we'll start to add, I think, some more hedges, particularly covered calls. We may even reduce equity into that ramp, depending upon what the other indicators are saying. But for right now, it is green light, and you have to be careful about getting too aggressive because, the macro and the valuation says that we could easily, be a lot lower than this in the market. We just don't know when that turn is going to come. So, number one goal here is to try to make returns for our clients, but not give back much on the turn, and that's what we're trying to do. Right now, the arrow is pointed up.
Okay. So despite your concerns about valuations and whatnot, we've long talked about how while they're a good indicator of risk, they're a bad indicator of timing. You are becoming more optimistic in the near term about where things might head.
That's true. It's probably a warning sign. So, for your viewers, I mean, they may think that, hey, New Harbor is getting more bullish here. Maybe that's a contrarian signal. Maybe it is. But just remember that what we're talking about here is very modest. Like I said, going from 45 to 47.5 is not a big move. And we have the discipline on the downside. A lot of people are passively long this market. Those are the ones we worry about. If we start to go down and take out our stops, we'll retreat pretty quickly. So we have an active strategy versus a passive strategy. And I'm just saying that the stars are starting to align to a condition where we could easily get a squeeze higher. And like I've said before, I think on this program, watch for something like 500 S&P points up in a short period of time, 2 or 3 weeks. I think that'll tell us that we're real close to the end and that the blow off is here. That's only one of many scenarios. Right now, I'm guessing based on the broadening that we might be building this blow off. And again, if we get that big up move, that's not a reason to jump in. That's a reason to get more defensive. And we'll be talking about it here.
Okay, and I'm glad you mentioned that. So you have for a while now, I don't know if I want to say predicted, but you've said your expectation is that wouldn't surprise you if this large bull rally that we've been having would end in a blow off top like that, and then that would be a high point, obviously, and then you think that there could be a quite material correction that could follow. We're not seeing the blow off top yet, but you're basically vigilant for it, I guess is what I'm taking.
The variables are starting to align for it, is what I'm saying. And it certainly hasn't started yet. Again, some of this is guesswork because nobody knows the future, but it really has to do with the time that I've had in my career since 1999, that this bubble's been going this whole time. And every little correction has been rescued with more money printing. And the only thing that's really making sense now at this point is some kind of blow off top. And again, we're not trading from that perspective. We're not relying on that, but that's what it's looking like right now. And if I had to quantify this guessing, like I said, look for 500 S&P points up in like 2 weeks. That would be like 5 to 8% in a couple weeks' time. If that happens, that doesn't mark the top either, but that means that theory is right, and it means be careful because that means we're in the final moves. So that's,
Okay. Well,
again, I don't want people to go more in. I want them to actually start thinking about pulling out if that happens.
right. And so we'll have you guys obviously on this channel weekly, as usual, going forward from here. So if indeed we start seeing that type of price movement, you can flag it in real time for folks.
Will do.
So John, heading over to you. So as Mike said, in the near term, sounds like you guys are getting more comfortable with opportunity in the market. You've increased your equity exposure a little bit. Your indicators, as Mike said, are pretty green. So Mike also mentioned that the breadth of the market seems to be increasing. Again, those are healthier signs. So as you look into 2026, what do you see as driving the markets? Is it going to be more just the hyperscalers again, or are you expecting to see capital rotate more into the other parts of the market that have been a little less loved in the past year or two?
Yeah, that's a great question, Adam. And in a word, we do think there'll be rotation. In fact, we're seeing it. We've seen some pretty, notable rotation underneath the hood of the market. And we as much as anybody are guilty of talking about the market as if the S&P 500 is the market, and what it does is what the destiny of investors is. But that's not really the case. And perhaps I can just, by way of illustration, share one of our dashboards. This is just one of many tools we look at. But this is a sector relative strength kind of dashboard, if you will. And just some quick deciphering this for viewers. You have the various stock sectors across the top here, technology all the way to consumer non-cyclical. I've got this sorted by weekly, going back a couple of years. And the simple kind of way to read this is, the green, this is a relative strength screen. It's a systematic measuring of price action of every sector and constituents of that sector relative to others. And by and large, you want to look at folks, sectors that are in leadership and have momentum and trending. So you have, for example, on the right hand, technology, communication services, industrial, basic materials, financials. And at the lower end, you have some of these sectors. Now, what you see is these don't statically hold position. In fact, they rotate. And these numbers in the bubbles there are meaningful. They're what we call a tally count, the signal of the strength of the signal, if you will. So a couple of notable things. So for example, look at basic materials. Mike mentioned that we just added a slight bit more equity exposure. We didn't add that to the S&P 500. We added it to a global basic materials, specifically metals and mining. Even within these sectors, you can look at subsectors. And much of the strength, you see these tally counts have consistently improved for basic materials. This is things like copper and steel miners, base metals. It also includes chemicals and things like that. But even within this sector, the real strength is in the kind of metals and mining. And we're not talking about gold miners here. This is totally different, kind of more base metals. And that's actually where we added some recent exposure. Look, on the other hand, you see financials, while they're still in a pretty good relative strength position, the strength of that signal has been consistently weakening. We actually rotated out of some targeted financial exposure a couple of weeks ago in favor of rotating into some basic materials. And we actually did add some healthcare exposure too. That you can see as, even though it's still in a longer term sense, still catching up from a relative strength standpoint, in the near term, there's been some very significant improvement. So these are the kinds of things that we routinely look at and monitor for. So you can have a market that languishes or goes nowhere, but you can have some very stealth, positive developments underneath the hood that you want to be looking for. Energy, for example, if we go back to 2022, the last bear market in the real bear market in the stock market, energy was one of the bright spots. It was, bright green, just to pick a color here. And energy actually did quite well in 2022 when most other sectors, including technology over here, languished quite bad. Energy has been a laggard for much of the last couple of years until recently. We've seen some pretty strong strength. And even within that sector, the oil and gas services companies have been much stronger than, for example, the producers or exploration type companies. So those are the kinds of subsurface rotations that we are not only seeing, but we expect to play out further as we head into the new year. Technology has been losing some strength. And so I absolutely do think there's probably a good chance that we see the hyperscalers become yesterday's news a bit, and other things start to pick up the slack, and probably stealthily. It probably won't be on the headlines, but we'll see it in some of these, kind of systematic indicators that we follow every day.
All right. So let's talk about that. So we don't know exactly what's going to happen, but let's say you're right there and that the hyperscalers become yesterday's news. They have been driving the markets so much for the past several years. Can they become yesterday's news without cratering the markets? Is there a way for them to gracefully cool off and hand the baton to other sectors to keep powering the S&P even higher? Or is so much of the S&P, and of course even more so the NASDAQ, dependent on those very few stocks that if they correct by any, meaningful amount, it drags a huge chunk of the market down with them.
Yeah, that's simple arithmetic. If we do see these very large cap hyperscaler companies start to really, weaken, mathematics are pretty simple. A typical S&P index fund, which is cap weighted, will see that weakness. Now take that same cap weighted index and equal weight it. So those companies have much less influence. You could have the equal weighted S&P do relatively fine, even if the cap weighted is languishing, if those do in fact start to weaken. But you might see small caps start to pick up more. Just because the S&P 500 cap weighted may see some heaviness if these hyperscalers start to lose some allure, doesn't mean that it's everything goes to crap, so to speak.
Mhm.
But you want to be very selective and systematic in picking. And there are plenty of sectors out there that I don't think will be immune from a major market sell-off, but they are much more kind valuations. I talked about the global metals and mining exposure we just added. You look at that sector, it's gone nowhere, more or less. It's been strong recently, but since 2010, it's more or less gone nowhere in terms of action. So there's plenty of areas that are not over hot or overly bubble like
They don't have the froth.
yeah, you just want to be very selective, and broadly speaking, especially for passive investors, you want to greatly reduce your equity exposure, right? We very much think that we're getting very close, even, and as Mike mentioned, a blow off top here is going to be certainly in our minds not just an invitation, but almost a mandate for prudent investors to de-risk. Just by way of mentioning something that just came across my screen, the investment firm Apollo just did a little study a couple of days ago, and they basically said, someone that invested in a 60% stock, 40% bond portfolio back in 2019 and basically just closed their eyes and held it passively till today, that would look more like an 80% stock, 20% bond portfolio. Now, I'll remind folks that not only is that, more heavily weighted to stocks than many people want to be, if that was their initial mandate. It's at a time when the U.S. stock market, broadly speaking, has never been as richly valued as it is now. Now, that doesn't mean that valuation has to matter today or tomorrow, but it matters. It will matter. We are highly confident in the kind of timeframes that most retirees rely on their portfolios to be safe and sound for. And that's just another way of saying we urge folks that maybe are a little bit displugged from their portfolios to take a good hard look, use this changing of the year as a cleaning of house, so to speak, and making sure your portfolio is properly positioned, because we do have risk out there in spades, and valuations being the most dramatic of that.
So, John, just asking you to cast your eyes on the year ahead. What is New Harbor's sort of default expectation for 2026? And I mentioned earlier that we've had 3 now back-to-back strong double-digit return years, which is statistically aberrant in and of itself for the market. A fourth, while possible, statistically speaking, isn't probable. And I know you guys at New Harbor have had lots of concerns about both the economy and valuations in the market and whatnot. What's your default assumption for this year? Is it going to be more of a flat year, another up year, or more of a down year?
Yeah, well, so some of those simple statistical metrics that you just mentioned there, X number of positive years, unlikely to, certainly those weigh into some framing of what's likely ahead. There's always the possibility for those trends to get upsetted, and we don't put too much weight on those simple stats, but you could combine record valuations, you combine the extension. We, as Mike has already alluded, we see the ingredients for kind of a blow off top of kind of thing. There's sentiment indicators that are getting a little extreme in terms of positioning and things like that. Back that up with a monetary and fiscal environment that has suddenly become very accommodative again in words and deeds. The Fed has started to expand its balance sheet again. People will pick semantics that this is or is not quantitative easing. Quite simple. It's stimulus in our view, and it is quantitative easing in the sense that it's printing money, figuratively speaking, not literal printing presses, but these aren't being paid for by base dollars already in circulation. It's an expansion of the monetary base to buy those treasury bills, and this, they're framing it as a reserve support, measured, not true quantitative easing. That's just semantics. And then you've got, the whole drama about who the Fed chair is going to be, and the one-upping of the candidates to who's going to be more dovish, who's going to be more, supportive of interest rate cuts. Yesterday, President Trump put a post out on Truth Social that, if you read it word for word, is like they're going to run this thing hotter than you can imagine in terms of, throwing everything in the kitchen sink at it, and who knows what that means for inflation and stuff like that. We're not that smart. We'll let the market tell us, what the market thinks of that. But this has very much the markings of probably some strength into early next year, but an invitation to sell. And we're not really good, because it's not within our framework to say, hey, next year is going to be X%. Here's our target for the market next year. Take this year, for example. Many people will conveniently forget that in April, we were technically registering a bear market in the stock market. Who would have thunk, right? So the path of how things play out over time is as important, if not more important, than the end result, because the psychology, especially for folks that aren't working anymore, they're relying on their portfolio for their retirement security. That ride has as much, if not more, importance than the actual return number that we see at the end of the year, which is just an arbitrary day of the year, the calendar year. And so I think there's a very good chance we get some very, very, very significant turmoil next year. Would not at all be surprised to see markets down or barely up. But the ride along the way, I think it's highly likely we see a true bear market. If you use 20% as the metric, I think it's quite likely we see a pretty sizable drawdown next year.
Okay. So you've mentioned a couple times, John, you guys are active managers, a passive approach, which maybe did fine, over the past decade or two. We've talked about this a lot. May not be the right approach going forward from here. Sounds like you think just sort of like 2025 was. I mean, to your point, right? If I told you at the beginning of the year where we'd end up, you'd say, "Oh, well, then this must have been a really fun year." Well, no, it was pretty gut-wrenching in the first third of the year, right? So this year had a lot more volatility than the previous 2 years. Sounds like you think that there's going to be more volatility ahead from here, and that the set it and forget it crowd may, they might be setting themselves up for disappointment, and therefore a more active approach going forward for a year like 2026 is probably in better order.
I think that's exactly the way we see it. Fed chair, new Fed chair, midterm elections. There are a whole host of catalysts you might point to, and it doesn't matter which spark, but there will likely be plenty of sparks to join a concert of other concerns, valuations, and extensions of certain sectors. We think there's high likelihood it's not going to be a sit back and enjoy the ride kind of year.
Okay. All right. So Mike, let's head over to you. So one of the things that has been a standout of 2025, we had the hyperscalers, and they continued to get bigger and more essential to driving the market. But also the precious metals really finally came into their own. You had been, I want to again give you props for telling people, you were showing the charts at the beginning of the year. You're saying, look, I think the metals are coiling here. I think they've got some good upside. And the breakouts that you anticipated indeed happened. And I'm going to say they happened even more violently than you expected. So love to get your thoughts just in general on what's happening in the precious metals complex right now. The day we're talking, I think both gold and silver are at all-time highs. Just check, silver futures are at $72 an ounce, which is crazy. Sounds crazy hearing those words come out of my mouth. But the key question for you, Mike, is as wonderfully as they have performed this year, do you expect that momentum to continue over into 2026, or have they just gotten ahead of themselves in 2026, maybe more of a cooling off year?
Well, let me try to respond to that in a brief way, Adam. And you're right, the move in silver and to a lesser extent, gold has surprised me, has surprised us. There's nothing prescient about what we were talking about back then. The metals were coiling. We've been long believers in real assets, the whole debasement trade, the fact that we think we're entering a climax of a fourth turning, and we can see that the central banks have been all in over these last 10, 15 years really had us convinced that metals made sense. And metals were in this long consolidation, which was painful for the bulls. We had the high back in 2011, and gold lost 40% over the next few years and didn't hit a new high, I don't think, until about 10 years later. So let me show a weekly chart of silver. And so this has been really great for us, our clients, and anyone that's believed in this trade has really worked out great. And frankly, it's exceeded my expectations, like you said. So here, this vertical dotted line is the beginning of 2025. This horizontal red line is what we call the triple top over and over again on this program. This is SLV, so this is going to be a little bit off the spot price. This is about, oh, I don't know, $5 or $6 below the spot price. But the spot price and this are the shape of the curve is the same. We talked over and over about a potential triple top at 35 right here. One, two, three. And on that break, we added a small position to our portfolio. We talked about it here. It's been a much bigger move than we thought. I mean, silver is saying something is different. I don't think this is your average parabola or you know your average kind of blow off parabolic move in commodities, which often happens. And I don't think this is at all like 2011. In 2011, we hit $50 an ounce, and we pretty quickly collapsed from there. Here we hit $50 an ounce and we just kept going. And so again, the triple top breakout at 35. We went up, we consolidated for the next 2 months, created this triangle right here. And we were saying, look, this thing looks like it's coiling. And lo and behold, boom, the next 3 months straight up brought us right up to $50 an ounce. That's the old high. And look what happened. We consolidated for about 8 weeks. And the last 5 weeks have just been breathtaking, Adam. You know, we just came out of that $50 range and went straight up to 72, as you said. So the question is, what now? Well, shoot, I don't know. I mean, this trade is getting a little bit hot. A lot of people are talking about it. It's all over Twitter. It's all over the internet. But I don't think I would just say that that's a good reason to get out. I think this is a good reason to evaluate your position and to sell on the way up. We've been telling people to sell back here and here and here and here, all the way up. And a lot of people are really over-concentrated. And when I say over-concentrated, if you're north of 20 to 25% in metals, you really should start thinking about selling into this rally. I don't think we're going to collapse. In fact, I think gold and silver are going higher. I think silver will probably break 100 in the next couple of years, maybe sooner. And I think gold will probably top 5,000, but that's not a reason to not take some of these gains. So we have 5 straight up weeks here. The trade is getting a little bit crowded. So just think about taking some off the table. Gold looks similar. Let me just take a look at gold or show you gold. On a weekly chart, triangle, consolidation, up, triangle. All these triangles build energy. And usually they break into the direction of the prevailing trend. Not always, but that's what's been happening. Gold is here at another high, right along with silver. I should say one thing about the gold-silver ratio. I think I've got the chart up here. Let me share it. This is from stockcharts.com. So if you type in gold, silver, this goes back to, I guess, just the beginning of the year. But back in Liberation Day, we were talking on this program like, shoot, we're up at 102 on the gold silver ratio again, you know, and since that time we came down to 62.76 as of right now. So we're starting to see a more normalized ratio. We could have some argument or some discussion about what a long-term average is, but by my eye, it's somewhere around 50 over the last 20 years or so. So, I mean, that might have some room to compress back down towards 60, but it's starting to get more normalized, which is again supporting my idea that you should start selling some into this rally. And one thing I see with a lot of gold bugs, so to speak, which is, I guess, includes us to some extent, is they don't ever want to sell. I'm going to bring up some mining charts and we'll talk about that as we finish. They don't ever want to sell, but if you don't ever sell, then it becomes kind of pointless to do it. You're kind of sitting around waiting for Armageddon and just waiting to pass on the metal to the next generation. If that metal is now 25, 35, 50% of your net worth, which it is for a lot of people we talk to, start thinking about some reason to sell some of it. And it's often hard for people. I had conversations this week. It's hard because they don't know what to do with the money and they don't want to go back into dollars.
Right.
You know, all I can say is think about something real to do with it. Do something with your house, go on a trip, whatever. Let's take a quick look at the miners. The miners have had huge moves. Here's GDXJ, here's GDX, and SIL, SILJ. They've all had monster moves. Some might say that the miners, particularly in silver, are starting to lag a little bit in recent weeks. I don't know. It's almost like the market doesn't believe that silver is going to stay up here at 65 or 70. I think it might. And if it does, I think we're going to start to see the miners, particularly in the silver area, catch up a little bit.
Yeah,
So
the analysts say that. Do you sense this is like a consolidation, a coiling, like we've seen the metals do?
I think so. Let me go to the daily chart here of this is SIL, the Silver Miners ETF. You can see that we've kind of been going sideways for 3 days. Let me look at the juniors with you here and then compare it to the metal. The juniors have been going sideways for a few days. They've roughly, um, we're up about, what is that, about about 20% in the last month or so. I haven't prepared a chart, but that is about the same, I think, as the metal's been up. But take a look at SILJ here, just going sideways, and then compare that to silver. And silver in the last 3 days has been going straight up. So some people are short term saying, what's going on here? Are the miners suggesting that we're at a top? Is the market not believing the silver will stick? I have no idea. And making short-term predictions like that's dangerous. And it's all over Twitter. If you look there, a lot of people are saying, well, geez, the miners are suggesting a top in silver. I don't really want to play that game because as likely as that could be, it's equally likely that the opposite might happen, that we might actually see silver miners catch up and launch out of here. If you look at SILJ, for instance, you take this base right here. This is the cup and handle base. The cup's here, the handle's here. And you see that we've got around, what's the depth of this thing? From 21 to 26 anyway, maybe even 27. So that's 5 or 6 points. If you add 5 or 6 points onto this, you're up at around 32. That's the next reasonable target for SILJ, for instance. And it's probably going a lot higher as long as silver doesn't collapse. So we'll stop sharing now. Nothing in the market is easy, but all of these indicators point higher. I believe the miners in general will continue to outperform. And that's in general what our indicators say, particularly in the gold space. The miners are outperforming the metal. And be careful calling a top. I've learned that you can't really call a top. All you can do is sell on the way up if you're already in it. And that's what we're telling people to do.
Okay. And on that point, Mike, to the folks who've been accumulating physical ounces. So let's say they're of the mindset of, I don't really want to sell those ounces, Mike. I plan to hold them for years, decades, right? Um,
Hmm.
uh, and yes, silver could correct, you know, from here and maybe has a down year next year, whatever. But I feel like in 5 years, it's going to be a lot higher. In 10, 15 years, it's going to be a lot higher. So what would you recommend those people do to hedge, right? If they don't want to sell their ounces, but they don't want to just be sort of naked long their position.
The first thing I would do is I would challenge their statement that they don't want to sell their ounces because that's part of the problem sometimes is they just don't ever want to part with that gold or silver and they should start to think about some of that. I've had a bunch of conversations this week and I can think about three in particular that I actually helped them sell some of those ounces. But if they absolutely definitely don't want to sell those ounces, I would review with them what portion of their investable assets are those ounces. If they're north of 20 to 25%, then that gets into the slightly heavy position because we've long said 5 to 10% is what you should have in your investment account. But if you think about it, we've been saying that for a lot of years. And those people that took our advice might actually be at 20 or 25 or even 30% now, depending upon how the rest of their investment assets have produced. So we want to challenge that notion that they don't want to sell. But if they literally absolutely don't want to sell, It's a tough one, Adam, because the only real way around that, I think, is to use inverse ETFs, which I really don't like, particularly the leverage ones, or options. So if I guess if they wanted to use an inverse ETF, I would tell them to definitely don't use in a leverage one, use a non-leverage one, that might go short the miners to offset some of your position or short the metal, or we can talk to people about how to use options. The thing about options is it's buying insurance and it's expensive. So literally just buying puts on gold or silver is something we can talk to people about, but it's going to cost money. And so if you don't want to sell, which is what you really should do, that's the cheaper, easier thing to do. We would talk to you about buying puts. And we're happy to have a one-on-one conversation with anybody about how to do that. And just have to look at it as buying homeowners insurance or something like that, because it's going to cost some money to do it.
Okay. So thank you. You took it where I thought you would, and I appreciate you offering to help walk viewers through it who might be interested in learning how to potentially do this. So rightly or wrongly, whether for the folks that just don't want to give up their physical ounces, but do want to have some downside protection, yeah, you can you can use a hedge like buying a put, and it doesn't even necessarily have to be on the metal itself. It could be on the mining complex, which in theory should be levered to the price direction of the metals themselves, right? As you guys have done great work over the years with me, educating people on the basics of options. But I think the key thing to underscore there is if you haven't really used them yourself, to the point where you're pretty facile with them, rather than figure this out on the fly on your own and risk making all of the rookie mistakes. If you're thinking about hedging using options, get the guidance of a good professional financial advisor who is very well skilled in them and leverage their expertise on this. But to your point, Mike, about buying, the insurance, it's like you buy fire insurance on your home. You're thrilled that you don't need to use it, right? You're happy to spend that money and not need it, right? So if you're thinking, hey, look, silver at 72, for example, it just seems it's moved so far so fast. I'm worried about a snapback. Well, you buy some insurance against that. If the snapback doesn't happen, well, then you're enjoying all those gains of your silver having run up to $72 an ounce, right? But if it does, if silver drops into the 50s, you're all of a sudden super glad that you bought that insurance. So, anyways, folks, if this is something you might want to learn a little bit more about, talk to your financial advisor, or if you don't have a good one to talk to, feel free to talk to John and Mike directly, and I'll remind you how to do that at the end of this video. John, coming back to you. So, we're talking about, in this case with the precious metals, how to keep the gains that you've had. The investing game kind of follows a progression, right? First, you got to earn the money, then you got to save it, right? You got to put it to work by investing it, then you got to grow it, right? This year, a lot of people were able to grow it, right? They whether you were in the hyperscalers on the risk on side or whether you were in the precious metals on the risk off side, like you hit some great gains. So now you're in the keep it phase, right? How do I not let this windfall kind of slip through my fingers? Uh, Talk for a moment just about how you guys as a financial advisor help people think through that. And then I want to ask you both about the last phase of capital, which is using it. We spend so much time trying to figure out how to make the number go up on our investment balances. But that's not the end game. The end game isn't to die with the biggest number. The end game is to actually use that money for quality of life. So we'll get to there. But first, can you just talk about helping people on the keep it? Hey, I've gotten some great gains. How do I not screw it up?
Yeah. Well, so first of all, even though this year's returns across many asset classes have been quite nice, that doesn't mean every investor has enjoyed those. In fact, we've talked to plenty of folks who got scared out of the market in April because they were overextended, they were overinvested in the market to begin with. And when we saw all the scariness about Liberation Day and the market sell-off, some people ran for the hills. And we're feeling this sting of getting shaken out. And there's a combination of two things, panicking, but also being more heavily invested than they probably should have been in the first place. So that's the first thing. Psychology is by far the hardest ingredient in this whole thing. Markets are hard enough, but throw in human psychology makes it, infinitely more difficult. So yeah, the keeping it, well, first of all, is they're smart, well, reminding folks that this money is there for them to use, right? One of the privileges we get, we're very hands-on managers, but we're not sitting behind a computer screen showing up on CNBC making market prognostications. We're talking to real people. We get a privilege of talking to them about really personal things about their life. Sometimes they're joyous things, sometimes they're challenging things. And you know, we in some ways serve the role of a counselor. And I don't want to, I want to be humble in using that. That's a very esteemed role or title to bestow on oneself. But yeah, a lot of times we're talking about the human aspect of their assets. And it's as simple sometimes as reminding folks that it's okay to book some gains. It's okay to pay some taxes. It's better than losing those gains. And so what if you pay some taxes? Your money is enabling you to do the things in your life that you want to do or should be able to do. So it's a combination of that. It's helping them understand that they've already many of our clients have built a very sound financial footing. It's okay to say, I don't need to get the very top of a blow off top market if that's what's going to happen. You should not feel ashamed if you lean in a little more conservatively. If you feel like your biggest concern is incurring big losses, because the economics of loss are unforgiving. People forget that simple math. You lose 10%. No one wants to lose 10%. I can tell you, even years where we've been down small single digits, it still hurts. They don't like to see, understandably, their accounts be down. But so long as those declines are shallow, they're very easy to come back from without Herculean efforts. 10% drawdown requires an 11% subsequent return to get back to even. Take that number up to 50% drawdown, you need a 100% subsequent return. That's simple math that people sometimes fail to remember. So the math is easy. The hard part is the psychology. So a big part about what we do is reminding folks that your return over the next 3 months is not what matters. It's what happens over the cycle of your lifetime, frankly. And mitigating or diminishing the amount of downside for most people, especially in their retirement years, is as important, if not way more so, than getting the maximum upside. And that's a analytical experiment, but it's also a psychological one. So we try to weave those two things together to help clients be unstuck, if you will, when it comes to that.
Okay. All right. Well, look, I mean, I've talked a lot about this in the past, so I won't continue to hammer it too much here, but the discipline that working with a good financial advisor brings the average investor is super valuable. And a lot of times it's the unsexy stuff, right? As you're saying there, John, right? I mean, it's just the rebalancing. It's just the things that, it's the person to say, hey, look, I know you don't want to pay taxes on these gains, but be fortunate you have the gains, and lock some of these gains in, because gains on paper don't necessarily always stay gains, right? So you want to take some of these unrealized gains and make them realized ones to make sure you actually get the benefit from them. So that, and also just having a process and a structure that oftentimes removes the emotional wanging around that our human brains do with us. So anyways, again, thank you and kudos to you for all the work that you've done over the years, for the many the many clients that I've sent over to you guys over the years. All right, so just to kind of bring this conversation to a meaningful, and I think a really practical close. So we're having this discussion. It's Christmas time. Hopefully, hours after you guys get off this interview with me, you're going to be sitting down at a table with your loved ones and really experiencing what true wealth is, right? And I talk a lot in this program about how money is a means to true wealth. It's not true wealth in and of itself. And true wealth really boils down pretty simply to quality relationships, living with purpose, and having good health. And, right now I've got this stupid cold, so I'm definitely being reminded about how important having good health is. It is keeping me from spending time with my family and my loved ones, because I don't want to, give my family, especially my wife's, parents who are in their 80s, whatever I've got. So it's keeping me. So I'm actually getting a real time reminder of the importance of these real wealth things. So At the end of the day, we're all working to get our financial wealth as high as we can get it, uh, not just to have a big number on paper, but to be able to fund our life's goals and dreams. So, can you guys just talk for, just in providing some closure here at the end of the year, how do you guys work with people to help them uh, crystallize what those goals and dreams are and put together a plan to get there and then help remind them, hey, you're focusing a little bit too much on just the number going up. Now's the time to actually focus on taking that number and doing the things you want to do in your life while you still can do them. So, I guess, John, let's go to you, but then Mike, we'll let you answer this as well.
Well, yeah, Adam. So certainly, we as individuals have our own goals and aspirations, but our clients are their own unique people, and our job is to help them and realize their own unique desires, right? Not to impart our views on things necessarily, but I'll just give you a glimpse of the kinds of conversations I know Mike has had, and everybody in our team has these conversations nearly daily. In just the last handful of days.
Sorry to interject, but if you include in your answer here, like I'm going to guess, and correct me if this is an incorrect assumption, but a lot of times when people, approach you initially, they might not be crystal clear on what their future goals are, right? They might need some help in actually getting all that clarified and then quantified, correct?
Absolutely. Absolutely. That's a big part of what, so we have some financial planning software that we can and oftentimes use with folks. And uh, I would first say that these are just black boxes. They can be very improperly used with the assumptions going in. For example, assumptions about returns going in. I would say probably 9 out of 10 financial advisors that are using these are making some outlandishly optimistic assumptions about returns, and that's not good because it's not grounded in reality. So these tools are fine as long as they're used with doses of reality. We have tools to walk clients through and analytics on those kinds of, hey, resources versus goals, and hey, do things balance out? Are you going to be okay? So we have as good a tools as any firm, I would say, but it's the application and the exploration and tire kicking of the assumptions and the framework that I think is really where the value comes. So, so for example, and like I'm going to go probably not on a limb here. Most households that we serve, there's oftentimes one spouse that is more in the driver's seat, if you will, than the other in terms of financial decisions and wherewithal. And sometimes there is a unintentional, the spouses may be all well loving and caring for each other, but there's this unintentional gap in understanding and even ability to articulate what each spouse wants. So oftentimes the most valuable conversations we have is when we have spouses together and we're talking to them. Hey, let's talk about your goals. Let's put some price tags. And oftentimes it's the first conversation they've really ever had. Again, not to over value or overemphasize our role, but it's kind of it's really heartwarming actually because you get to see the spouses look at each other and say, you know what? It's kind of crazy, but I don't think we've really had this conversation before. I'm glad we are finally, and oftentimes you hear things and you'll see one spouse's eyebrow go up saying, really? That's how you feel? Like, wow, well, why don't we talk about this earlier? So, I mean, again, I don't want to emphasize our role in unlocking those things, but that's a huge part of it. And sometimes it's just giving people permission. Sometimes the fear they have keeps them from doing things they really want to do. In just the last handful of days, we've processed a bunch of folks' requests to donate funds to charities sometimes, and we help them in smart ways to do that, whether it's through qualified charitable distributions from their IRAs to avoid income taxes, or gifting directly of appreciated securities from taxable accounts that avoids the need to have to incur capital gains. These are all the kind of the nuts and bolts financial things that we can, optimize for them. But it starts with, helping them really get in touch with what they want to do and then give them permission in some cases that they can actually do it without having to worry. Had another conversation with, parents, and they want to help their children are independent on their own and working really hard, saving money. But they want to do some lifetime giving to not only from a smart estate planning standpoint, but also to help their children. There's a book out there called Die with Zero that many people might be familiar with. On the surface, it sounds like this hedonistic, spend all your money and die with zero. But it's more about like, hey, if you've got resources, why not use them impactfully during your life if you can, and not just at your death, right? Sometimes at your death, it's like a little too late that, other people, including family members, might have been able to enjoy those resources more positively, I suppose. So this particular couple would like to gift some money to their children to start to help them build up a further down payment for a house someday. And that's, perfectly, and they very much want to make sure the kids have the discipline that they get a mortgage, that it's not a gift of a home, but just a helper, kind of thing. So sometimes walking through those things in terms of, can we do this in the realm of our needs? Because we don't want to, kind of put your own life, your own oxygen mask on first, kind of analogy on an airplane. You don't want to starve yourself by giving too much to your kids or family or whatever, or charity. So all these things are, yeah, they're mathematical discussions, but they're just as much psychological and emotional and feeling peace with decisions.
All right. Well, a great answer. Right. Well, Mike, coming over to you. First off, anything to add to that?
Yeah, Adam, I think that we probably said this many times, and John just said it too, that we do act as therapists, financial therapists for people, and I definitely don't want to usurp the hard work or the authority that licensed clinical social workers or therapists have. In fact, frankly, if I wasn't doing this job, I think I'd like to be a therapist or a social worker. It's the type of work that I really enjoy because I can connect emotionally and heart to heart with people. But maybe it's just because of sheer life experience. And after doing this for 25 years, you get to know people. And I think that we're uniquely equipped to help people in this slice of their life, how psychology connects with money. And, like John just said, a lot of times we're meeting with a couple. And one of the two couples is the squirrel, gathering the nuts or the acorns. And the other one is the one that wants to use them or do other things. And a lot of times we can bridge that gap and help people feel like it's okay to use some because most of our clients, and I know this is probably a good problem to have, most of our clients really won't ever use most of their money. It's a human nature thing to gather as much as you can because nobody knows the future. We don't know what storms are going to come, but the whole purpose of this is to live your life. And to the extent that we can prove to people, either through our own experience and tell them, look, you've got enough, or even with financial planning software to prove mathematically, and it depends upon what type of the person you're talking to, by the way. Some people need to see the evidence, other people just need to hear somebody that has the experience tell them that it's going to be okay. Whatever it is, it can allow them to release a little bit and do some things. Put the addition on the house, redo the bathroom, go on a trip to Europe, give money to charity, like John said, give it to the kids. After all, that's what it's all about. This money is kind of not even real anyway. Our government's just making it up. So bring it down to something that is real. Bring it into your life and do something with it, even if it's little by little. Talk with us if you want to have some experience behind that based on people that have been there and have seen a lot over the years. But that's what this job is all about to me, and happy to help.
All right. Well, hopefully this has been grounding for folks in terms of what it all means in the big picture of things, right? Why are we doing this? And at the end of the day, you know, what you want to get clear on is okay, how do I want to use this money if I have been successful in everything else, earning it, saving it, growing it, keeping it, et cetera, right? A lot of people I know who watch these videos are well on their way to success there, if not already very much at success. And so, I encourage everybody during this holiday season, while you're spending time with the folks that you love the most, and you've got a little bit of a break from your usual routine and grind, that you do some reflection on, all right, well, what are the things I want to manifest in my life while I still have, good years ahead of me, that I can bring to bring into creation using the money that I've worked so hard over time to build. I mean, again, at the end of the day, money is the means, it's not the end in itself. And I presume, guys, that anybody who wants help with thinking through that can contact you guys and, leverage your guys' expertise as financial counselors and helping them kind of put that vision together if they don't have it clearly in their mind, and then, putting timelines and progressive plans into making all that happen, correct?
Absolutely, Adam. We love having conversations. No pressure. we've been fortunate enough to build a business here that is sustainable and growing, and we can truly just embrace incoming inquiries just for the natural conversation that it's meant to be. And if we can part a couple minutes of value to anybody that talks with us, that's enough reward for us. And I should say, it's not just Mike and I, of course. We have a great team that we work with. We've been very deliberate to grow our team with the kind of good people that we know our clients deserve. And we'd be remiss if we didn't give a great shout out to our team and express our thanks for our joint role together on behalf of our clients.
All right. Well, look, gentlemen, thank you for, again, offering those services to everybody as generously as you do. Thank you for coming on this week, the day before Christmas, to film this with me. Thanks for coming on this channel with me every week to share your insights with the Thoughtful Money audience. A huge amount of gratitude for you guys, and nothing but the best holiday wishes for you guys, your families, your wonderful team there at New Harbor. So folks, look, if you'd like to get some help from the team at New Harbor or one of the other financial advisors that Thoughtful Money endorses, to set yourself up, not just for hopefully a prosperous 2026, but as I was just mentioning, really clarifying how you want to use your wealth to enrich your life in the big picture, then consider scheduling a free consultation with one of these firms. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitment involved. It's just a service these firms offer to be as helpful to as many people as possible. And if you can also, guys, to viewers, please join me in thanking John and Mike for coming on the channel by hitting that like button. And if you haven't already, clicking on the subscribe button below, as well as that little bell icon right next to it. John and Mike, I think this is the last recording we're going to have in 2025. So I just wish you guys and your families all the best.
I think so too, Adam. And we're really grateful for your viewers, for you primarily, but I think even more so the viewers. I think that you and I would both agree on that. Without the viewers, none of us would be here. So this platform we're very grateful for, and the opportunity to do some good in the world. Thank you, Adam, and thank you all for tuning in every week.
Cheers to that. Thank you, Adam. Happy New Year. Merry Christmas. Happy holidays, everybody.
All right. Take care, boys. Yes, happy holidays to everybody watching. Thanks so much for joining this channel. As Mike said, none of this would be possible without you, the viewers. Wishing you the best of the holidays, a very happy new year, and we'll see you soon on the channel. Thanks so much for watching, everybody.
Right now, silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge. If gold just stood still and silver went to, 2% of it, silver would be $70 or so, But gold will be going up there in that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position, we said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000.
Silver is gaining momentum and looks set to outperform gold, with analysts expecting it to break past its old highs and potentially reach $60 to $70 as it catches up. Even if gold held steady, silver could rise to around $70 at 2% of gold's value, but since gold is also climbing, silver's outperformance is likely to accelerate. With gold's rally restarting and long-term projections pointing as high as $10,000 to $20,000, the strongest focus right now is on silver within the monetary metals. Michael Oliver is a seasoned market analyst and the founder of Momentum Structural Analysis. He explains that gold has spent the past 5 months consolidating in a sideways range, frustrating skeptics who expected a major correction. Instead of falling, gold held firm and is now breaking above $3,500, signaling renewed momentum. This pause acted as a cooling-off period, setting the stage for the next surge higher. Analysts suggest this rally will be powerful but not the final peak, with potential targets of $10,000 to $20,000 in the long term. Silver and gold miners are also showing strong outperformance, with silver expected to surge towards $60 to $70 before any meaningful pullback. Unlike past rallies, this move is supported by deeper global and macroeconomic shifts. The dollar index has been flat for nearly a decade, yet gold has more than tripled, showing that other forces are driving demand. Weakness in treasury bonds, signs of a topping stock market, and risks of a sharp Bitcoin decline could all funnel more money into precious metals. With these pressures building, gold and silver may see explosive upside before year-end, as investors rush to safe havens amid mounting financial instability. Before we begin, please subscribe and enable the notification bell so you stay up to date. We'd love to hear your thoughts, so please share them in the comments.
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct, it's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly. Like 3 times it got up to 3,500 or 3,450. Right now we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it and they kept getting these $100 and $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. And our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. Because we've blown out the idiot highs, which means, pardon me, those who missed the move had ignored it and doubted it, will suddenly say, well, golly, I got to be in that, okay? And then you get a further gush of money into a fairly small market, which could easily goose it into that zone, and we've got some reasons for that zone. But ultimately, there could be a correction up there, not the top. So if you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro-technical events going on globally and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas like the breaking of the dollar has not been a factor, the dollar index, when you measure versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015 when gold made its low. It's trading around 98 right now. We're trading just below 98. So, yeah, it's been above it and below it since then. But 10 years, it's been net lateral. Well, why is gold not net lateral? It's 1.5. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further wind for gold. Then we go to the T-bonds. T-bonds are usually an alternative. If you have a perception of a weakening stock market, people will tend to move money into T-bonds as the alternative. They're not. T-bonds are very anemic. They're very weak. They're behaving more like the stock market in terms of when they make lows and highs. And right now, T-bonds, as we speak, are not far away from some levels that if they break below, you could end up getting a little mini bond market event, which would spook the stock market. Anyway, there's a lot of these factors out there, including Bitcoin, I think, which is in a potential crash situation. We've been saying that for a few months. Not that we're there. The trigger numbers are still below us, but if you hit those trigger numbers, that could suddenly become an off-the-sideline type, oh my God, where did that happen? How did that occur? And it will have wave effects because the financial institutions are now so heavily involved in crypto. So anyway, these events are out there percolating, and I think they're going to occur. And when they do, that could create further upside panic in the monetary metals. And I think we're going to see that between now and the end of the year, possibly sooner than that.
Michael thinks that gold's rise since 2015 can't be explained by the usual drivers like a weak dollar, falling stocks, higher commodities, or bond shifts. Instead, it reflects something bigger, deep distortions created by government control of money. These forces are converging, setting up a cascade that could spark central bank panic. Silver is expected to break past its old $50 high and surge towards $60 to $70, drawing in late investors before any correction. Still, that would only be a pause, not the end of the bull run. Historically, gold has delivered 2 8-fold moves in the past 50 years, and repeating that pattern today would put it near $8,000. Analysts argue this wouldn't even be unusual. It would simply mirror past cycles. Michael predicts that if gold does reach those levels, silver could climb dramatically as well, possibly reaching 2% of gold's price. Commodities may follow along, but the real fireworks are expected in gold, silver, and mining stocks, making the coming surge both dramatic and highly concentrated in monetary metals. Now let's revisit the interview.
Explain, we showed in the weekend report the chart of gold since 2015, and there's this upward plotting action and then it's accelerating. And you say, well, what caused that? And it wasn't because it was the declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so it will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks. Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because I could go way beyond it, gold has had a couple 8-fold moves. 1976 low to the 1980 high, 8-fold gain. 2001 lows, 2011 highs, 8-fold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000. You would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move. You go to $8,000 gold, wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know.
Michael Oliver highlights that both gold and silver are entering a powerful new phase, driven not by traditional market factors but by deeper systemic distortions in the global monetary system. With gold potentially targeting $8,000 to $20,000 and silver set to surge past its old highs towards $60 to $70 or more, the precious metals market may soon witness one of the most dramatic bull runs in history. This rally, fueled by weakening confidence in traditional assets and central bank actions, suggests that silver and gold miners could offer some of the strongest opportunities in the coming years. If gold were to reach $8,000 or higher, how high could silver realistically climb relative to gold's value? Do you think central banks will intervene directly in the silver and gold markets if the rally becomes too explosive? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
In the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds. 100 to 200 would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LB delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. Annual production of silver is not increasing, it's plateaued, and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it. Okay. And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
The purchasing power of the dollar has is fallen 99%. Those are the numbers you're saying. 99%. The dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce. And that was from, 1856 or something. And it was... it was de facto, but then it became de jure with the Gold Act in 1900. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs, pushing up prices, if you like. That's so much like Germany between 1922 and 1923.
Although the dollar's decline began earlier, it has already lost about 99% of its purchasing power since it was separated from gold. Deutsche Bank has explicitly warned of a crisis of confidence in the US dollar, suggesting that shifts in global capital flows might overwhelm usual currency fundamentals, causing erratic moves. JP Morgan says the dollar's long bull run is ending, with an expected 10 to 20% medium-term decline against the euro and yen. They see this not as a collapse but as a gradual reset. By 2026, increased tariffs and a failing dollar might cause prices to rise, a scenario similar to Germany's inflation crisis in 1922 to 1923. The dollar has lost around 99% of its value, albeit the slide started earlier. The 1900 Gold Act established that $20.67 would purchase 1 ounce of gold until 1934. Now, in mid-2025, JP Morgan warns that U.S. tariffs, trade policy, and slowing growth could lead to stagflation. They lowered their U.S. GDP growth forecast for 2025 to 1.3%, from 2%, owing to tariff impacts. They also expect foreign demand for treasuries to decline, which weakens one pillar of dollar strength. The International Monetary Fund (IMF) has also flagged that recent U.S. tariffs could add inflationary pressures and warned of weakening domestic demand and slowing job growth. The Roaring Twenties and the 1929 crisis were both exacerbated by Hoover's tariffs and the Fed's credit expansion under Benjamin Strong. Now, the risk is much higher and might destroy the currency due to Trump's tariffs at the height of a huge debt bubble. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, basically, what you've said it all. I mean, the purchasing power of the dollar has is fallen 99%. Those are the numbers you're saying. 99% since the dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce, and that was from 1856 or something. And it was, it was de facto, but then it became de jure with the Gold Act in 1900. Basically, when the Fed came along, they screwed everything up because under Benjamin Strong, they expanded credit. I mean, Benjamin Strong was a great believer in stimulating the economy with extra credit. And that led to the Roaring Twenties, which led to the collapse between 1929 and 1932, enhanced, I may say, by not President Trump, President Hoover's tariffs at that time, which was the Smoot-Hawley Tariff Act of 1930.
Yep.
And President Trump is doing exactly the same at the top of the debt-cum-credit bubble, which makes 1929 look like a pimple. I mean, this is the big one. It really is. And it'll destroy the currency. I think it's so important. We've got to understand this, and we've got to be prepared for it. Yeah, I mean, basically, no. We used to have a phrase, which I don't hear nowadays, about kicking a can down the road. People, I think, sort of think, whoops, I don't think it's, they start talking about a reset and, all this sort of rubbish. I mean, the fact of the matter is that the Fed has got no control over the situation. And it can't have control over the situation because the situation is politically driven. And until you persuade an electorate, to give up all their welfare this and welfare that, and, all the pressure groups to, that, look, you're out of here, forget it. We're actually going to deal with this one seriously. Until that happens, no. I mean, there is absolutely no solution, Craig. And, I've always said it's crisis first, solution second. I mean, once you have the crisis, then you can start talking about a solution. But is that really going to work? Well, I'd like to think so. But the fact of the matter is that when you get those extreme economic and monetary conditions, like, the credit collapsing in terms of its value, all bets are off. This is what they found in Germany, because what happened in 1920 to 23 led to Hitler, led to the Second World War.
Right.
Hayek actually put this very, very well in his Road to Serfdom. He sort of had a bit where everybody starts saying, we need a strong leader, to get us out of this mess, because they'd had enough of the weak politicians who screwed it up. We need a strong leader. And what did they get? They got Hitler.
Germany experienced 3 stages following World War I. The first, from 1918 to 1920, saw the mark lose roughly 80% of its value, akin to the inflation that followed the COVID-19 pandemic. The second, from 1920 to 1921, saw a brief improvement as the mark strengthened, business resumed, and optimism returned. And the third, from late 1921 to 1923, concerning parallels can be seen in the U.S. today. Officials are publicly pushing the dollar lower, markets have soared, and bond yields are still high. Only short-term T-bills are in demand, as foreign investors are shunning long-term treasuries. The dollar may plummet if bond yields increase while the Fed lowers interest rates. When tariffs are added, we may witness a crumbling dollar and skyrocketing prices by 2026, akin to Germany's hyperinflation. Since exporters benefited, politicians and business groups at the time even favored a weak mark. Similar to this, current policies run the risk of devaluing the dollar's purchasing power even while they may benefit certain groups. Let's dive into the interview.
Yeah, we're not quite there yet. You mentioning the, Adam Ferguson's book, When Money Dies, and all the rest of it, actually hits the nail on the head. Because I put out a note, I think it was a few days ago, which looked very, very carefully at what happened in Germany between 1918, which was the end of the First World War, and 1923. And there were 3 phases. The first one was between 1918 and 1920, when the purchasing power of the Reichsmark fell about 80%, something like that. So, this was a nasty situation. Now, this is actually quite like what happened following the COVID shutdowns.
Right.
And then we had this inflation, which meant that the purchasing power of the dollar actually fell. Not as much as 80%, admittedly, but it fell quite sharply. And then what happened in Germany from around about February 1920 to December 1921 was suddenly things improved. And the Reichsmark actually went up against the dollar, which, remember, was on a gold standard, on a proper gold standard. You could exchange your dollars for gold at 20.67 to the ounce. So the Reichsmark was strong. Businesses were recovering, if you like, from the shock, the post-war shock. There was a certain amount of tourism going on. Things were really humming. The stock market tripled. Everybody thought, this is absolutely wonderful. We've got over this, etc., etc. But then there was a crash. I think the stock market lost something like 25% in the December of 2021.
1921.
Sorry, between 1921, end of 21, in other words, through 22 and 23, what happened was that the purchasing power of the Reichsmark began to collapse. And the collapse was total. Now, so far, we've had the post-COVID thing, which led to inflation, da-di-da-di-da. And now, guess what? Perhaps the long bond yield has not really declined. It's still held between 4.5% and 5%, and looks, if it goes through 5%, then we will be bricking it. It really will be very serious. But meanwhile, of course, the S&P went up from something like 4,200 in 1922 to where we are now, which is 6,500. This actually looks very, very much like that period in Germany between 1920 and 1921. So what follows? Well,
Right. That's the bad news.
this is where we are. So how is it going to happen? That's the question. Well, I can see a number of things. We just had Stephen Mirren appointed to the FOMC. No, he's not quite there, but it's just a question of signing on the dotted line. He will be in the FOMC. He was the Mar-a-Lago guy who wants the dollar down and reckons that he can get everybody to agree to it. Well, good luck to that. I mean, they are going to destroy the dollar.
Yeah.
The foreigners so far and large institutions, for some reason, are asleep at the wheel. They don't understand what's happening. There is a deliberate policy to drive the dollar lower. And if you look at the chart of the trade weighted, it is awful. It's about to fall from where it is, which is about 197.5, down to 90, and I doubt it'll stop there. So what's this mean? This means that the purchasing power of the dollar is declining. Now, on top of that, what do the foreigners do? Well, I mean, everybody, including the large institutions, stand back and they don't buy treasury bonds. I mean, certainly with anything mature, in terms of length of maturity, they're not going to touch it. The only thing that will sell is near cash, which is actually what T-bills are. It's almost like cash, printing cash. So that's what's going to happen. Now, you will get a rising level of bond yields just at the moment when the Fed is trying to reduce interest rates. Well, that's going to do. They're going to have to reverse that. Or the dollar tanks. And if the dollar tanks, what does that do to its purchasing power? It begins to collapse. And then, on top of that, we've got tariffs. Now, I know everybody's running around saying, well, tariffs haven't had any effect. But it does take time for this to work through. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs pushing up prices, if you like. And, I mean, that's so much like Germany between 1922 and 1923. So the next question is, I mean, we all reckoned that the Germans were muppets and stupid and all the rest of it at that time. But actually, if you read the history, you see, well, it was politics. It was politics. Because it lowered their manufacturing costs. You had the inflation king, Hugo Stinnes. You had, and this is a familiar name even today, Fritz Thyssen, steel magnate, etc. I mean, it was wonderful for them. They were making huge money because their costs were based in Reichsmarks, and they were selling it into global markets and getting gold-backed dollars for it.
The warning signs are obvious, and preparation is crucial, regardless of whether the dollar experiences a similar fate. Will authorities intervene before it's too late? Or do you believe the United States is on the verge of a disaster akin to Germany's collapse in the 1920s? Should the dollar really start to depreciate by 2026, how should investors position themselves? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you.